Hi, I'm Kenton, and this is Kenton Knows. I want to share my thoughts about how to evaluate whether you should invest in residential real estate or a real estate investment trust, also known as a REIT. I'm not going to list things like depreciation, leverage, yay, real estate wins. If you've watched any of my other videos, you know I'm going to go a little deeper. As a disclaimer, I'm not recommending or advocating either. I have personally owned investment properties for the past 17 years, and I also currently own shares in many different REITs. In my opinion, there is a good reason to own both, but you really need to understand what you're getting into before investing in either. If you enjoy this video, please hit the like button, consider subscribing, clicking the bell, and leave me any comments as well. I will provide a lot of details to support my opinions throughout this video, but it will ultimately come down to each person's appetite for risk and the time you're willing to dedicate to either investment. I will try to explain each point in simple terms, but if I start to lose you on some of the more complicated areas, don't despair. It won't last long and it won't take away from the major points. Let's start with the basics. First, we'll start with REITs, which are definitely much simpler in comparison from an investor's point of view. Each REIT may invest in a particular real estate asset class, such as multifamily, retail, hospitality, industrial, etc. Or there are some REITs which invest in multiple sectors or attempt to match the REIT index. One thing I hear often is that owning real estate allows you to leverage your investment with a loan, and it's risky to leverage a REIT. My main issue with that statement is that REIT managers are highly intelligent managers who do secure loans on the properties held in the REIT, which are usually at better rates than you can get, in addition to capital received from the sale of the REIT shares, which is what you as an investor would purchase. So the REITs can get money at a lower cost and they do leverage it. Here are the basics. REITs buy, sell, manage, and collect rent for real estate property. REITs must pay out 90% of their taxable income, including rent and proceeds from property sales to the unit holders. REIT income is treated as business income to the REITs, which means all rental-related expenses can be deducted and written off at the trust level, and the income distributed to the unit holders is not taxed to the REIT, but it is taxed as income by the unit holder who received the dividend. So you'll pay taxes on REIT dividends at your personal income tax rate, but unlike company dividends, the REIT didn't pay corporate income taxes on that income before it was distributed to you. Here are the reasons you might want to consider owning a REIT. Liquidity. You can buy and sell your investment any day the markets are open with essentially no transaction costs. Diversification. A REIT usually invests in many properties across the country or world. Income. REITs must pay out 90% of their income, so you'll normally receive a nice income stream in addition to asset appreciation, which normally results in a higher value of the REIT. Owning a REIT will give you real estate returns with essentially no work on your part. You don't need to do anything after you buy a REIT other than determine when to sell it. Yet, you are participating in real estate investments with professional management and corporate oversight. REITs have a comparatively low cost of capital and leverage their investments with loans against the real estate. Most REITs have highly intelligent and experienced managers who have dedicated their careers to getting unit holders a higher return while managing the risks associated with the properties, tenants, and the market. Although I personally don't see these as negatives, here are some of the commonly cited reasons to not own a REIT. You don't own a specific property, which in my opinion is a good thing as you're more diversified with multiple properties. No control over the properties chosen or how they're managed. I also see this as a good thing, as you're relying on an expert to choose the right property that they think will get the highest return versus your limited local knowledge of real estate. REIT share prices can be subject to general market volatility, not necessarily just based on the value and profitability of the properties owned by the REIT. This is just a market risk of any asset. I hear people say they don't like REITs due to the inability to write off depreciation and expenses on their personal tax returns. While this is true on a personal level, it's a little bit of a misstatement, as REITs do write off depreciation and expenses at the business level before paying dividends to their unit holders. So you actually do get the benefit, it just comes to you as a return of capital, which is actually taxed at the capital gains tax rate and not as ordinary income. and you as the unit holder don't have to deal with a more complicated tax return. Even if you don't understand that, just know that as a unit holder, you are still benefiting from depreciation and other deductions. I'd encourage you to do your own research on the historical returns for REITs. I'll just say that over the long term, they have comparable returns to the S&P 500 index, though they are not strongly correlated, and REITs perform slightly better in non-tax accounts such as IRAs, since REITs can have large distributions that would be taxed in your non-tax advantaged account. Now, with that behind us, we can move on to owning your own investment property. My personal expertise lies in apartment ownership, but professionally, I have worked in corporate real estate development, construction, property and lease management, mostly in the retail and office space. In this video, I will keep this comparison focused on owning residential real estate. To start, please know that owning your own investment property is significantly more time consuming than you may realize, and it comes with both high risk and high reward if you are successful. Before I start, be aware, there are people that have lost everything when getting into investment properties, and at the same time, there are also many people who are able to quit their job and simply live off the rental income. To be successful, you will, in my opinion, need to treat it as a business that requires a lot of work. First, you'll need to educate yourself. Before buying a property, here are some things I'd recommend learning about in the area you're looking to invest. Rental rates, sale prices, mortgage rates, insurance, taxes, capital required, your ability to manage and make repairs, or the cost of a property manager, what lease to use, application, and approval of new tenants. How will you do credit checks? How will you do background checks? How will you collect rent? What are your deductible expenses and what isn't? How you'll keep track of your income and expenses separate from your personal income. And most of this is easier with a team that includes a mortgage broker, insurance broker, an attorney, and a real estate agent. The more you learn to do yourself, the lower your costs will be and the higher returns you'll achieve per property. The main point is that there is a lot more to know and manage when you own property directly. So the big question is whether all that work and education is worth it. Let's talk about the benefits first. When you buy a property, you own a tangible physical asset that you can touch and feel, which a lot of people really enjoy, myself included. Personally, I find it extremely satisfying to see properties that you own. You have complete control over the location, number of units, when to repair or upgrade, how to evaluate tenants, what to charge, control of the cash flow, how to manage the property, and when to sell it. With that control comes the work, worry, and responsibility as well, which is constant. When I say constant, I mean constant. I mean, you'll get texts, you'll get emails, you'll get tenants saying they lost their job. They'll tell you they're going to be late. They'll tell you the neighbor's loud. They'll tell you some other random thing happened, and it's always coming to you or your property manager. But you'll always have to deal with these issues because there's constant stream, especially the more properties and more tenants you have. Yes, you also get tax deductions. Deductions include the cost of locating the property to buy, closing expenses, repair expenses, depreciation of the asset and capital improvements, your mileage driving to and from the property, tax and interest expenses, advertising and commission expenses, utilities, legal and insurance. All of these expenses offset your income, and it is possible that you may show a tax loss but actually be making money. This usually occurs when your income minus expenses excluding depreciation is positive, but then the depreciation reduces your taxable income below zero. So you have a tax loss, which you can carry forward, but you actually had positive cash flow from the property. Another big component of owning a property is the ability to finance it. Assuming you have good credit and assets to get a loan, real estate financing is usually the least expensive money you can borrow. As rates go down and hopefully your property value goes up, then you can refinance a larger loan at a lower rate so you can take cash out of the property and hopefully not significantly impact your monthly mortgage payment. The really nice thing about taking cash out of a property is that the cash you take out is tax-free. You don't pay taxes on taking cash out of your property, and you can deduct any closing and financing costs. This all sounds great. Now, why wouldn't you want to own your own property? The downside of financing is if your property goes down in value and or interest rates go up and you need to refinance your loan, this will also result in your monthly mortgage payment going up. And you may have to bring cash to the table for the refinance. And this is what can push a property into foreclosure, and you can lose all of your investment. This is only really an issue if you have a short-term loan that must be refinanced. If you have a 30-year loan, you can dramatically reduce this risk. Real estate needs to be constantly managed and maintained, which can be very time-consuming. Think about all the things you do to take care of your house. Now, remember, all of those things need to be done at your investment property, and your tenant is not going to be paying attention or taking care of the property the way you would. On top of that, you'll need to manage and pay the utilities, property taxes, insurance, and mortgage while managing tenant issues. Did the tenant pay the rent on time? Maybe they want to break the lease or they're trying to sublet. They don't want you to do any showings. The toilet's leaking, the refrigerator isn't working, the roof is leaking, and they're withholding rent until you fix it. The tenant's complaining because the person above them is too loud. The list is endless, and these are all real things that I've personally dealt with at all of my properties. This doesn't come close to the bigger issues like a sewer line breaks and you need to dig up the floor in a basement apartment with the tenants there. Or having to evict a tenant, which is by far the most time-consuming and annoying part of owning apartments. Yes, you can hire a property manager to deal with this, but in my experience, they're not as invested in the long-term profitability of my properties as I am. And I can't accept the agency cost to my profitability. You may also want to consider that if you hire a manager, it may be harder for you to claim that you are an active investor or a real estate professional, both of which offer higher tax advantages than a passive investor classification. You need to make the best decision for you, but I feel strongly that the success of my portfolio is a direct result of the time I have put into managing it myself. Also, owning real estate is really an illiquid investment. If you want to sell, it can take months or longer to sell, and the transaction costs are very high. Real estate has a long cycle, so if you are forced to sell at the wrong time, your return will be significantly affected. Per the article written by Harvard Extension professor Theo Nicholas, link below, with supporting data going back the past 200 years, the real estate cycle has land values peaking every 18 years. And in 2016, Theo predicted the next peak to be in 2024. See the link to his article below. It's really a great short read. With a single property or a few properties in the same general area, you have a concentrated risk in your local market or sector. I think it is easy to underestimate this risk, as we normally have a positive bias to believing in the future growth of our local area. None of this even contemplates the risk of a lawsuit, which, when you own your own property, is significantly higher, and no amount of insurance or limited liability companies can protect your assets and future income if you are ever found liable for negligence. If you are the manager and you knowingly fail to correct a problem, then there can be significant consequences. So, what's the conclusion? In my opinion, if you do the research, find decent deals, and put in the time and effort to manage real estate, you should earn a significantly higher return than you would investing in a REIT. But realize you are also taking on considerably more risk as well. The biggest considerations should be, are you willing to put in the time to learn the business? And do you want to spend a lot of your time managing real estate investments? If you hire a property manager to reduce the time you spend managing your investments, you are getting closer to your own personal REIT. But you'll have less diversification, higher personal risks, and your deductions may be limited as well. In the end, it really comes down to your personal tolerance for risk and the amount of time or effort you want to put forth for your real estate investment. You really can get wealthy by either, and I'm always looking for opportunity in both, but be aware that owning your own real estate will require a significant investment of both time and money. I specifically didn't go down the route of comparing rates of return, as it isn't a fair comparison. REIT returns are directly impacted by the manager's many years of experience, and the REIT literally pays for every hour anyone spends working on the properties in the REIT. If you don't take your time into account to learn the business, find your properties, make good investments, and manage them, you will surely beat the REIT's return because you are valuing your time at zero. You are operating in a much less efficient market than the REIT operate in, meaning that you can find smaller properties which are more likely to be mispriced with less competition to buy them. If you take all of your time spent on your investments and then multiply it by an hourly rate, your investment returns might not look as good, but your net worth should be significantly higher due to the time and effort you put into your investments. That is the big takeaway. Without question, there are much greater risks, higher rewards, and a significantly higher amount of time and effort required to directly own residential investments when compared to buying a REIT. Buying and managing real estate directly will give you a higher rate of return, just due to the fact that you will be investing in a less efficient market and you will be doing all of the work essentially for free, as your pay will be in the form of a higher valued asset or higher cash flows, where no one at the REIT is working for free. I really hope this video helped you understand the differences between investing in REITs or directly in your own property, and it will help you decide what is best for you. Please like the video, subscribe to my channel, click the bell, and leave me any comments about this topic. Also, please check out my other videos and let me know if there's any other content you'd like to hear from me about. Thank you for watching Kenton Knows.